Over 40 and investing monthly. Stop guessing where your money should go. In 60 seconds, I'll show you the smarter way to direct every dollar. We'll map your cash into 3 buckets and use 4 simple rules to choose every single month. Stay, Rule 4 changes everything. If you're over 40 or 50, chances are you already have a 401k, maybe an IRA, and more than one fund. The real question is, what are you supposed to do with them? Where should your monthly investing actually go, especially when you're not 25 anymore? Manifesting money. Real strategies for real life. Everyone talks about dollar cost averaging, but nobody tells you where that money should actually go. What if you're putting your monthly contributions into the wrong place? In a minute, I'll show you where most people go wrong. Stay with me. The final rule is the most important. Real midlife investors have multiple positions, multiple goals, and less time to recover from mistakes. We'll turn confusion into clarity. Let's make your good habits even better. Coming up, the 3-bucket system. And I'll share one powerful insight at the end that changes how you invest every month. Let's start with the basics. What is dollar cost averaging? It means you invest a fixed amount of money at regular times, like every month. For example, you invest $500 on the 15th of every month. You do this no matter what the stock market is doing. When the market is high, your $500 buys fewer shares. When the market is low, the same $500 buys more shares. It automates your investing, takes emotion out, and smooths your average price over time. For a young person, it's often perfect and builds a great long-term foundation. However, as we get older, our needs change. We're still growing our money, but we're also protecting it. We have less time to recover from a big downturn. A simple automatic buy into 1 or 2 funds might not be enough to get you there safely. The habit is wonderful, but we need a system that adapts to markets and goals. It's not about abandoning DCA, it's about upgrading it to fit your life today. Let's add a layer of strategy on top of your great habit. To bring clarity to this complexity, I want to introduce a simple but powerful idea, the 3-bucket system. Imagine 3 large buckets in front of you. Each bucket has a different job. Every month you decide how much to pour into each one. From a confusing collection of funds to a clear, organized strategy. The buckets are named for their job: growth, income, and safety. Growth grows your money over the long term, higher potential returns with higher volatility. Think broad market funds, tech ETFs, strong growth stocks, for example, VOO. Income pays you through dividends or interest, more stable, slower growth. Example, a dividend fund like SCHD or certain bonds. Safety protects your principal, very low risk, little growth, there when you need it. Think high-yield savings, money market funds, and short-term government bonds. Seeing your funds in buckets transforms your monthly decision into a clear framework. Next, I'll give you 4 simple rules to guide monthly allocations. In a minute, I'll show you where most people go wrong. Stay with me. The final rule is the most important. Now that you have your 3 buckets, how do you decide where to put your monthly investment money? Here are 4 simple rules to guide you. This is your decision tree. Each month, run through these rules to make a smart, confident choice. This turns automatic DCA into an active, strategic decision. Rule 1. If the market is at or near an all-time high, favor your safety bucket and your income bucket. When the market is expensive, pullback risk is higher. Don't go all in on risky growth now. Direct more to income at fair prices or to safety to build cash. Keep money working while reducing risk. Rule 2. If a strong growth fund you believe in is down, buy into growth. If the S&P 500 or the Nasdaq 100 has dropped, this is your chance. Your monthly dollars, buy more shares on sale. Rule 3. Feed your long-term winners. Support high-quality, diversified funds, not yesterday's hype. Rule 4. Check your progress. If you're behind, shift more into growth. Within 5 years of retirement, favor safety and income. In a minute, I'll show you 4 real scenarios so you can see this in action. Let's make this real. Imagine your monthly investment is $1,000. Growth, VOO, QQQM, income, SCHD, safety, a bond fund or money market. Scenario 1, the market is at a new high. Rule 1, caution. Put 200 into VOO, growth, 400 into SCHD, income, 400 into the bond fund, safety. You're still investing while lowering risk. Scenario 2, your favorite tech fund is down 15%. QQQM is off its peak. Rule 2, opportunity. Put 700 into QQQM, growth, and 300 into SCHD, income. You're buying a quality asset on sale. Scenario 3, everything is steady and you're feeding a winner. Rule 3, feed the winner. Split the 1,400 to VOO, growth, 400 to SCHD, income, 200 to the bond fund, safety. Scenario 4, you're 5 years from retirement and on track. Now prioritize preservation. Rule 4, protect the nest egg. Put 0 into growth, 500 into SCHD, income, and 500 into the bond fund, safety. You're building a wall around your savings to protect it from market volatility. Now we've arrived at the single most important idea I want you to take away today. Here it is. Dollar cost averaging is just the delivery system. The choice of which fund to buy is the strategy. DCA is the reliable truck that shows up every month with a box of cash. A wonderful habit and discipline. But the driver doesn't know where you need the supplies. You must give the directions. Your 3-bucket system is organized storage. Your 4 rules are the intelligence to decide based on the weather, the market, your inventory, and your progress. You are no longer a passive recipient. You are the active manager. Once a month, take a few minutes to think, apply the rules, and direct your money with purpose. This is the key to navigating your 40s, 50s, and 60s with financial confidence. Balance growth with protection. Buy growth when it's on sale. Build defenses when markets are expensive. Protect your timeline so a sudden storm doesn't derail your journey near the destination. Your financial journey is a marathon, not a sprint. Start by identifying which of your investments fit growth, income, and safety. Then next month, use the 4 rules to guide your contribution. You can do this. You are in control. Thank you for spending this time with me. I wish you all the best on your path to a secure and prosperous future. This channel shares calm, practical guidance for midlife investors. It's education, not financial advice. If you want real, hype-free help, subscribe to Manifesting Money.